Welcome to Money Chats and Mishaps, a podcast by Fam Brokers hosted by Renae Long, the director and founder of Fam Brokers.
So welcome to Money Chats and Mishaps. I have Mr. Matt Mercer here today from
Mercer and Cooper.
Mercer and Cooper. So Mercer and Cooper do, I call them bilingual, because you do the financial advice, investment strategy side of it,
Yep.
and the property side of it.
Yes.
So bilingual for me means you do more than one thing. It's better than saying they're a buy agent, because that has a lot of different, you could speak multiple languages,
Connotations,
anything,
yeah. Yes.
right? So can you tell us just a little bit about you?
Yes. So we come from a financial planning background, which is why, using your term bilingual,
Yeah.
we treat property like it's a financial planning product, even though it might not be treated that way legally or through the ASIC process. But it's no different in our eyes than any other investment type where you invest to create wealth. You're not doing it just for laughs.
Yeah.
And so especially with investment property, we're chasing the best growth, the best yield, which is rent, and the best tax deductions if that's a need. And so we
Now,
have
I'm
a
gonna
strategy
stop you there.
discussion
So
first.
it's an
yes.
education bit. So a lot of people come to me and say, what is yield?
Mm-hmm.
So yield isn't something you put in bread to grow, because I had a client say, is that like a product that you put in bread to grow?
Like yeast?
Yes! And I went, no,
No.
that's yeast, not
No.
yield.
Not the same.
So, yeah. So
Yield
can
is
you
a
just-
financial term just meaning the revenue as a percentage of the price. In layman's terms, it's rent.
Yeah.
So the rental return as a percentage of the price is called the yield. So if it's bringing in $20,000 a year in rent and it's a $400,000 thing, it's a 5% yield.
So the reason why I asked you for that is I get asked 1,000 questions after this, and people ask for things, and I've had clients where I have said to them, and this is the Reader's Digest version, so somebody thought, well, I did say you need a JP to sign your business contract, your home loan, your mortgage.
Mm-hmm.
They went out, searched on Facebook for somebody with the initials JP and got it signed. The bank phones me up and I'm like, I don't know who that person is. And they said, it's in your box, sort that out. Phoned the client, who's such and such? And they went, you said I need a JP.
That's
it took me
fantastic.
3 days to find them.
That is
and so
fantastic.
that is my litmus test for me, because I know it and I assume you know it. So
Yeah.
I'll talk to you like you do.
Yeah.
But if you don't, and I don't ask the question, and I have to take some onus of responsibility
Absolutely.
to say, I didn't say justice of the peace. They're the person that you find in the shopping centre. So now I provide the justice of the peace map, the local JPs. I provide everything, so I don't have to. I printed off the contract. I met him in a solicitor's office. I paid for the solicitor. I walked it down to the bank and physically handed it in so we could settle. But I won't make that mistake again. But you know what you know, but you don't know what you don't know. And
Correct.
then you think. And I've got clients that have poorly performing properties with great rental yields, and they've paid the property down to pretty much nothing, or they've got great both, or they have great growth and not as much yield. But it's and I have honestly, which is quite sad, had the. So is it like something in bread? Like,
That's
does
fantastic.
it make it? Yeah. Well,
I've never had that one.
yes and no.
But you can't
So-
assume. So, and because we, as
So
a
thank
company,
you for
and
that.
because I have been in financial services for a long time, you make an assumption and you speak the lingo, and you sometimes
What's
it's
an
not.
LVR?
Exactly.
What's an EMV? What's an EMV? Is that like a new car? No.
LMI and all these
Yeah,
things.
yeah.
We just quote them. Yes.
Exactly.
So no, you have to break it down, and that's part of the initial strategic sort of the discussion, with understanding who they are, what they know, what they've done, what they're trying to achieve, and so you can tailor it. But you have to do that, otherwise they head down the road without knowing what they're doing.
We see people in the most vulnerable state. It's almost like they're financially in a sheet and nothing else. Because, well, we see them for where they basically are.
They're see-through.
Well, pretty much.
Yeah.
Because you find out so many things along the way, and you do as well.
Yeah, I do.
I want to buy 5 properties, and yes, I've got 6 properties. Actually, you've got 1 property. You've bought 1 property in your super, and that's a little bit different, and this is how we're going to service it. And
People don't understand the lending industry, and
Yeah.
like I had a woman in our office only a week ago, and she said she wanted to buy 10 properties in the next 2 years.
wow.
Because her income had gone up significantly. She was getting hundreds and hundreds of thousands of dollars a year. But that isn't the only thing that's required to buy 10 properties in 2 years.
Exactly.
And so she'll be a long way off that. But she's just assuming that the banks will give her the money. And so,
And people don't look at funds to complete
no,
or any other costs involved.
correct.
So, yeah. So when you're dealing with somebody, you look at the overall.
So we take a
it's the whole
strategic
house.
approach, because buying an investment property is not a difficult thing. If a broker can get you the money, you can buy one.
Yep.
But buying something that outperforms the average or outrents the average or gives you good tax deductions or achieves your financial goals in time is different. And it requires research, it requires a thought process around what are you trying to do. There's a risk profiling process we go through, because not everybody carries the same level of risk.
You don't go to the butcher to get your car fixed.
Correct.
So you go to somebody like you that knows the market and knows what it is. And there's a huge difference between if you buy in suburb X to suburb Y, where you'll be in 20 years.
Well, growth rate. People don't really understand compounding. And so, if we stopped people in the street and said, are you aware that one suburb can outperform another, over time, everybody knows that. But what that actually means mathematically, if you work it out for them, even a 1%, if a suburb did 5% per annum for the next 10 years and another one did 6%, it's hundreds of thousands of dollars in equity, pure equity and
pure
wealth.
equity,
right?
exactly.
And so why would we not think about that when we're going to buy an investment property? Because, why would we buy just because we like it? No. And
I
people
found
often
the
come to
house
me
for $125,000, but it's a Krakow. Okay?
Correct,
I didn't even know where Krakow was. Okay? And I'm like, where is that? I have to Google it. Oh, it's not exactly, no, that's not a first or second category. I'd have to come back to you with the LBR.
No, and it's not predicted to be outperforming the
No.
national growth. No.
Yeah.
So we're looking at growth rates predominantly, because most people are buying property to create wealth.
Yeah.
There's a lot of messaging out there on Facebook and in the media around, debt recycling, pay your home loan off faster, which is always a great idea, or buy property to get some tax back. They're great ideas. However, the real thing we're trying to do is wake up one day and be significantly wealthier.
Yeah.
And that comes through equity, which comes through capital growth. And so we want the best possible rent, we want the best possible tax benefits to the client, but ultimately we want higher than average growth. And that's researchable, because we understand economics, and we look at where is the next Westfield, where is the next hospital being built, where is there a huge shortage of supply but a massive demand. And all those sort of things that mean that this area's got a much higher chance of outperforming the market. And that most people can't do that without some research or advice.
And you've got systems and processes.
Correct.
And the algorithms that you can say, okay, this is where it is, that's where it is, and boom.
Yeah.
You blow someone's mind.
Yeah, I mean, it's not. There's no crystal ball, so to speak, as in it's 100% guaranteed. But economics always wins. So if there's a massive shortage of supply, and a huge amount of people want to be there, and they've just announced a new hospital, and then we have some understanding of what economics will mean for that area.
Infrastructure means a change.
Yeah, I mean, there's two key things that cause a certain area to way outperform the national average, and that is population growth and infrastructure spending.
Yeah.
And if those two things are in place, then we have and South East Queensland has been very blessed with that, where we happen to be, because we've had incredible migration into South East Queensland, and we have beautiful weather, and we have all that infrastructure spending, and so there's been just an incredible demand, and we can't keep up with it, which has meant prices are rising.
Yeah.
However, not every suburb is outperforming, so we still need to understand. And just because you live in a suburb in Brisbane or the Gold Coast doesn't mean that suburb is the top 10 or the top 20. So
I went to one of your mornings, and it surprised me some of the things that I learnt. So you know what you know, but you don't know what you don't know. And then you think, oh, I knew that, but I didn't realise that.
Yep.
And how much that was, because I thought it was the same as B, C and D, but actually no, so you understand some of the fundamentals, even if you're a savvy investor. So I've got clients with one house that at the moment 80% of my home loans at the moment are refinancing to buy an investment
property.
So at the moment I would say that's significant.
Yep.
And divorces with separation of properties.
So,
I have clients with 11 and 12 properties, but they're very small. Most clients will have like the 1 to 3.
Yep. That's common. I mean, the statistics Australia-wide show that very few people get past 3. Majority, like over 90% of property
I've got
investors
so
have
many
1 or
people
2.
that want to do it, that aren't and don't do what you tell them to do to get to there. But
Correct.
But some of them have got the assets and the equity, but it's failed to launch because they're scared. And then they come to me 3 years later and say, "Oh, if I'd have bought that 5 years ago, now I can't afford to get into it with that."
Yeah, and so procrastination is the biggest wealth killer by far in any area of life.
Yeah.
Waiting for no real good reason is the thing we try to fight all the time. I mean, if you've got a reason because you're changing jobs or there's something going on, that's fine. But we could still meet and talk about starting in 12 months.
Yeah.
But most people are waiting without a good reason. They're
So
waiting
you can
from fear.
change someone's life.
Correct.
I think finances are wonderful. So I used to work in communities and health. So you can change people's lives from assisting them or supporting them when they need it. You support people when they need it. And finance and property, I think, is an amazing part. We should all tap ourselves on the back and say, great job.
Yep.
We change people's lives. Stress, financial stress affects 76% of people. It impacts people that have got suicide ideation or other things.
Yep.
So, you know, it's a stressor in our life. And if it's something that they can come to you with and say, this is what I want, ultimately it's going to alleviate some stress.
Correct.
So with somebody that comes to you, so there's no ideal client for anyone, but if somebody came to you and said, I've got a house, I'd like to buy an investment property, what would be something that you could get them to think about so they can come to you after listening to this or seeing you or going on your website?
The critical thing is that you don't just want to buy an investment property because the goal is not to have an investment property. The goal is the wealth that's created from that investment property in a window of time. So if you're in your 40s or 30s and you have a 10, 15, 20 year window, then it's about creating a plan to generate equity or wealth so that you can stop and do what you wish to do, whether that be travel the world
Enjoy
or
life.
enjoy life, whatever retirement or whatever having choice means to you so that you don't have to work so hard. And so property is the vehicle that has got the most leverage, meaning you need other people will pay for it for you, and we can talk about that in a minute. But yeah, there's a lot of benefits to property over any other form of investment, and so but it's not about just going out there and buying something because it's for sale.
Yeah.
It's about what are we trying to do, and so if you're trying to create $1 million worth of equity and you've got a certain window of time, then we work backwards and we need to get a growth rate of 6.5%. So we need to look at regions where it's highly predicted to be higher than that because of all of these economic factors. So we take a analytical approach and a strategic approach to property. It's not very difficult to go to an auction and buy something and then you've got to find them the money, or to be sold something by an agent. And we're not against agents at all. They play a really critical role, but they're not giving advice that is tailored to your financial goals. And so we want to sort of sit in the space where it's buying a property is literally the last thing we'll do. Let's look at what we're trying to achieve first, because finding great properties in really strong growth regions with strong rental returns is not difficult for us. We have so many relationships, but so if somebody came to us and they had a home with some equity in it, it would be about, let's sit down and understand what are you trying to do. Then we need to understand capacity. So what price point, which is what capacity means, what price can they borrow up to? And then we start to hone in on regions that have, once we know what you can do financially, the price point of the property, making sure that we want to get the best rental return, the best growth rate possible. And that may or may not be right near where you live.
Yeah.
It might be 100 miles away. It could be in a region. So that's a process that we uncover as we have our first strategic discussion, because a lot of people simply can't get their head around having a property that isn't around the corner or close by. And
that you don't buy with this, you buy
correct.
with that.
So it's about trying very hard to use maths and economics and not too much emotion when you're buying an investment property, because emotion can be a killer of wealth. Because I mean, we've got clients that have bought apartments in Surfers Paradise and they're beautiful, but they have not performed financially. And I'm not against Surfers Paradise, but that particular property just did not go up anywhere near. And they could have bought 2 investment properties in 2 locations that went up double digits in the same time frame per annum. And so, we just want to have that conversation. At the end of the day, people will buy what they want, and we'll do our best
and it's
to
their
guide
choice.
them.
You don't make them.
We don't make
It's
them do
their
anything.
choice.
We just talk about this is
educate
what we
them
would
what
highly
to do.
recommend based on you and your tolerance to risk and your age and your income.
Do you find that, for me, I find I have clients that are so risky and just want to
Jump in.
boom, I just want to jump in. I'm all in.
Yep.
They're not even a quarter out. They're all in. And then you've got ones that are just scared.
Terrified.
Yeah.
Yeah.
How do you deal with both of those if they want a really high risk strategy to go for it?
So property comes under people and property, we have a risk profiling process, and it goes from defensive right through to aggressive. And then you it's very similar to financial planning. You're a defensive investor, or you're a moderate, or a growth, or a aggressive. And that's a risk profile. And so property should be treated the same. And so we have that conversation in our first discussion. Because if you try and put an aggressive property strategy in a newly forming region where it may or may not boom in the next 5 years, some people won't be able to sleep at night. And so we have to have a personalised approach to that. And so, but understanding the buyer, if they've got to 48 years old, got kids in their teens, they've never bought an investment property, and they've been paying off their home loan for 20 years, that tells us pretty quickly the kind of risk profile we're dealing with. If they've got a whole pile of properties and they've done some development and they're all sorts of, that's a totally different, it's a different discussion from our point of view. And we can go with either of them because we've done a lot of property purchasing ourselves. So we can play with any personality style, or wherever the people are at. It's very important that we tailor it, because you've got to be able to sleep at night and you've got to be able to be comfortable. And even if we can say you must do this, or you simply won't achieve your targets by the age of 60 or 65, it doesn't matter. They still have to be able to sleep at night. They still have to be comfortable with the advice, or they won't do it. And then they wait, or they get scared, or they procrastinate even more. So if somebody came to us with equity, we would understand where they sit on that scale of type of investor. But the most important thing is that they get in, because the market doesn't wait. The market doesn't wait.
Self-managed super fund investment properties have been huge in the last.
Self-managed super fund. Well, I say this a lot, and I probably said it when you heard me talk, is that nobody's got much money anymore. They've got equity or they've got super. And so we're generally dealing with refinancing and pulling equity out using you as the broker, or we're dealing with someone having super, which means they'll have a deposit in cash. They'll have to self-manage that super and then put a cash deposit down. And there are certain rules around that, but they're generally who we're dealing with for investments. Very few people are coming in with a wad of cash in the bank ready, unless they've sold something. But mostly we're dealing with your space, which is refinancing, getting a maximum borrowing potential.
I would have 80% on my book at the moment, and
super
every week. Well, at the moment I had the stream of super for the last 6 months. I've still got super coming in, but at the moment it's okay. We've paid down this to this, and we've got this on our property, and we've got enough equity. Can you work out how much we've got to spend, and blah blah blah. Yep, this is what you've got. Here's some people to talk to. I always give clients people their options.
Good.
Very few people would take it up unless I physically go with them, though.
To the person you recommend?
Yeah.
It's an interesting thing. I mean, property is one of those things that everybody believes that they know enough about it to do it themselves. There's no other investment vehicle where people would do that, right?
No.
Very few people would just ring a stockbroker and choose the stocks themselves and buy them. You have to have some knowledge. They go to an investment advisor and he'll give them a balanced portfolio. Crypto, whatever, they'll be listening to friends or colleagues or someone.
Or Donald Trump.
Or someone, some politician. But property, because we all live in one, or we know someone who lives in one, we go, oh no, I understand the market, And people generally feel like they don't need help. And so that's our first battle, is to say we'd love to give you some advice that suits you as an investor.
Because I think
and based on your time.
If you're going to purchase an investment property, you should talk to somebody else about it. I can tell you how much you can spend. I can restructure your loan. I can make it work for you. You can pay it down quicker. You can draw out whatever you want to do. But talk to someone else. There's reasons why buyer's agents are around. There's reasons why your general conveyancing and commercial lawyers are around. Real estate agents, financial planners, groups that can assist you project and say, and you do what I call the cushion effect. So at the end of it, you can assist. You'll drive along the lumpy road of life, up and down for everything. That's life. But when you get to the end, you want to have that soft cushion to sit down on. You don't just want to have, because if you pay for your property and you just pay it down and pay it off, what happens when you retire?
Well, you can't eat your house. And so people think, and I have this conversation all the time, because people get to this point in life where they think, well, I own my own home and I've got 550 grand in super, so I'm doing pretty good. And we don't burst the bubble, because that is good and they've done well. but that's nowhere near enough if you want to live on a good income for the rest of your life. And people are living older and older, and so some people may have 25, 30 years. And so
if somebody wants to live and $100,000 a year is what they're going to spend. Or
if they've got 550, then it tells us when they run out.
Yeah,
and then they've got to sell their home and buy a smaller one, and then a smaller one, and then a retirement home.
Yeah.
And so we try very hard at the start to have that conversation and create a strategy that means that when they do stop working one day, they get to a point where they've got enough wealth through equity and all their other assets, such as superannuation and other things they may have. That means they do not have to sell everything or sell down to survive. Yeah. We want the assets to create the income so that they have something they can will on. Because everybody, if you get to the core of human beings, we all want to help the next generation, especially if we have children. And so we want to give them a head start. We don't want to slide into the grave with our last dollar. So we nobody disagrees, but most people are not on track for that. And that's because they buy emotionally. They do things emotionally. And so that is our biggest quest with all clients, is to try and, this is not your home. This is a thing to achieve a goal. And so let's chase growth in rental returns, tax benefits, and get ourselves equity so that if you want to do it again and again, you have the potential to do that. And so, because it's not just about buying one and sitting there, although that will help. And you don't need 5 or 10. You do not. Most people with 2 or 3 properties will have a huge impact on their retirement. But we have to choose the right ones.
Yeah. So why? I know why that's important, but why would you tell somebody that that's important?
Which bit?
That multiple properties.
Having multiple properties? Because
what will that do for the average person?
Well, it changes everything, because we've got a few clients now that have gone right through the process to retirement. And so, they might have bought 3 or 4 properties. But because of the growth spikes that have happened across that window of time, maybe 15 years to 20 years, they literally have the ability to sell one and pay out mortgages on 2 because of the equity. So the equity in 1 or 2 of them literally is enough to pay out the loans on 1 or 2 of them. Yeah, we have to deal with capital gains tax, and there are smart accountants that can assist. But they've got to a position where they could end up with 1 or 2 investment properties and no debt.
Yeah.
And a home potentially paid off too if they had a mortgage still at retirement. And so ultimately that's what people want. They don't want to go into retirement age carrying
passive
debt.
income quite secure.
Yeah, they don't want to have debt in retirement, especially personal debt. But if we can have no debt on a home and 1 or 2 properties that have no debt as well, then you're getting, who knows what the rents will be then, $1,000 to $1,500 a week.
So have you ever taken someone out of the doo-doo, shall we say, and assisted them? Because a lot of people do step in doo-doo along the line.
So sometimes we have to go sideways before we go forwards.
Before we go forwards, exactly.
Correct. So
the side step.
Yes, there has been lots of removing people from doo-doo.
Okay.
And that's doo-doo in property is the wrong property. They bought something that's just... We've actually got a testimonial on our website right now. Came only a few months ago from one of our clients who had owned a property in Melbourne for 11 years. And he sat with us. We did a Zoom consultation with me. And my first thing to him was, after we developed a relationship, was that he needs to get rid of that property because he paid like $290 for it and it was worth like $380 after 10 or 11 years.
Oh, wow.
It was a little townhouse in the outskirts. And so we told him maybe 18 months ago that he's got to get rid of that. And he's written a testimonial saying that he struggled, he sold it eventually, he then bought something up in Queensland that we recommended. It was in Brisbane, and he made the same amount of equity in the last year as he did in the previous 10.
Wow.
And so, but there was it took a year.
Impactful?
It's huge. Yeah. And he wrote this glowing little words to us about what that's meant for him.
Nice.
And that the sort of stuff that makes you understand that we have to sometimes have tough conversations, because people do get emotional about what they own.
Emotional about what they earn, what they own.
Yeah, and so we have to have a conversation around, I often have people say to me, I want to buy a property in a suburb. I'll just say some suburb, random suburb of Brisbane. I want to buy a property in that suburb, and I'll say, well, why? And it's usually something personal. I grew up there. My brother lives there. My mum's there, and they're nice reasons. But then I ask them, if you got to retirement age and you created all the wealth you ever needed, but you never ever actually owned a property in that suburb, are you upset? And then they're not.
Interesting question.
They're not, right? Because they just want to create wealth. And so sometimes we have to have those conversations with people who own assets. Sometimes we have to have tough conversations about superannuation because people have been sitting there with poor super funds, managed like industry funds, that have just not given them the growth that they need.
Yeah.
And so we discuss self-managing and we get them into it, and then they end up moving forward with leverage in a property. So sometimes we have to, but in terms of getting people out of the drama or the doo-doo, as you call it, it's always around having a discussion around getting rid of what you've currently got and choosing something based purely on growth fundamentals, rental yields, and potentially the tax deductions if that's an area they need help in, or they have an income bracket that would benefit from that. And so, but that sometimes takes months and months to get people to actually choose to do that, to move sideways.
Yeah.
But the outcome is always
good. You don't get paid up front.
We don't know.
You have the conversations. So brokers don't get paid up front. For some reason, I always get clients that think that I'm on $1 million a year. I'm like, I wish, but hey, but how much are you going to charge me? So most your conversations, and when they find out that you don't, time is worth so much, and information's worth so much. So making that time will change someone's life.
Correct.
For the better.
Yes.
And if you learn that much, or take in that much, you've taken in something.
Yeah.
So your value add proposition is you're actually trying to generally benefit the client.
We want to create a client that we work with for years, which is very different than very different than all of our colleagues in the real estate industry. And I'm not against, like I said before, real estate agents play a really critical role, but they are generally making a sale, and they are selling something on behalf of a vendor, and they don't really know the buyer's details, and don't need to know their financial goals. They're just selling a property, and if you want it, you can buy it. And it's transactional.
Yeah.
And we want to create a client because we want to create a strategy up front that says we're going to do 3 properties in the next 5 years.
And you're not a
year
marketer.
1 and year 3. No.
You're not a marketer. You're not a seller.
No, we're not selling on behalf
of
a specific developer or builders or no. So we go nationwide. We have relationships with builders and developers and agents and what's called aggregators, which are people that have access to more than we have access to, property-wise. Everything that we talk about generally with clients is not sitting on realestate.com. So commonly referred to as off-market, but it just means that they are not sitting on a major website. You won't find them.
So off-market excites my clients. Every single client, and I've got a lot of people divorcing as well at the moment.
Yep.
Saying 1 in 55% of people now are getting divorced.
That's a shocking stat.
That is
That's
huge.
a shocking stat, yeah.
Because if you're going to grow wealth and you just keep stopping and starting, that impedes that.
We do a lot of work with some family law companies, and there's a lot of, and I'm generalising a little bit, but there's a lot of women who are coming out of that have not been the major financial person in the relationship, and so they're suddenly getting funds from a settlement, and they really don't know what they're doing. And so, and my business partner Bernice Cooper is having a lot of impact in that space with helping them get into property based on who they are, their age, their goals, and uncovering their goals, because sometimes they haven't really thought about it. Right? And so there's a whole market there, and if it is 1 in 2 or more, then there's a huge need.
There's going to be a huge market
there's a huge
there.
need.
Yeah. So for anybody out there, if they wanted to dip their toe in, if they wanted to talk, man, he doesn't have teeth. He's not going to bite you. He doesn't know you that well. Because I don't know, sometimes people get so scared to talk to somebody. You're not a loser. And I get people say, I don't want them to think I'm a loser. Well, you're not a loser.
No, and there's no silly questions.
There's no silly questions.
So as I said earlier, we were financial planners for a long time. So we were dealing with property, but also insurance and investments and managed funds and shares and all of it. And so we would see people and have them as clients forever. And we were dealing with all of their financial matters. Yeah. And there was still no silly questions. We never expect people to understand our world.
What 3 tips would you give somebody about purchasing a home, talking to somebody about purchasing a home? 3 tips.
Well, the number one thing sounds a bit obvious, but there is absolutely no reason to wait.
Yeah.
waiting has a cost. People think that I'll wait till the home's paid off or the kids have left home or whatever. It has a cost. It has a cost. Time is our friend in investment property.
Yeah.
And so the number one thing is sit down and let's have a conversation about what you can do. And if you can't now, we make a plan for when you can, so that you don't lose any time that you don't have to lose.
Yeah.
Because procrastinating or just waiting has a real serious implication. Compounding maths is a very powerful thing. And so if you had 15 years but you only ended up with 12, that last 3 years is actually where you made a huge percentage of your wealth, because it's now compounding on itself.
I've got clients that I had years ago where they've sold properties. Some made 290,000, some made $1 million. And
just
they
because they waited
at the same time.
That's right.
Because they waited.
It's a J curve. It's a J curve people don't understand. So the first 5 years you'll make X, and the second 5 years you'll make a lot more, because now it's compounding on larger amounts. And
so what's your third one? Sorry to interrupt you.
No, that's all right. So but procrastinating, it must be personalised. So don't think that you can just buy a property and your goals will be achieved. It really is a personal process, and you have to know that you're creating a plan to buy 1 or 2 or 3 investment properties to achieve X amount of wealth in equity in a time frame. And we can calculate that within an hour. We'll have an actual property investment plan that you can do all by yourself if you want to. It's yours. But we obviously would love to help you over time to do that. But it becomes your plan, and you can take it. And you know that if you achieve growth rates like this, purchase prices approximately like this, and you do it in these time frames, 1 or 2 or 3, whatever you can do through capacity, to borrowing capacity, it's maths. You will achieve your goal.
Yeah.
So if you get 6% per annum for the next 10 years and you buy 3 properties in year 1, 3 and 5, we can calculate exactly what that means in equity if that's your average growth rate. And so create a personal strategy. Don't just buy something because it's available, and don't buy something because it's near where you live, and don't buy something because it's cute.
I think that is one of the most important things you've said. I get clients, oh my God, you should see the bathroom. This is so quaint. And the laundry's near the kitchen, or it's got an extra toilet downstairs. That's why I want it. Look, people buy so many things at their heart. Look,
we've bought a lot of property over the years because we've been in this space. We own a lot of property, and some of them I wouldn't live in. And that might sound a bit, holier than thou, but they have never been unrented. They've grown incredibly well because of where they sit. And so the region is what makes you the money, not the house. Everyone knows you can depreciate the property. The tax office gives you tax benefits on the property because over time it's worth nothing according to the tax office unless you renovate it. But the value of where it sits and the land and the postcode is what makes you the money. And so please don't run out and buy something because it's for sale or because you can afford it.
Or because you're panicked. You don't think you can get in the market as well. You've got those at the moment. So there's panic buyers.
Yeah.
They're buying something with a turret and a circular staircase because there's a hole in the floor and a ladder going up. And it's like, this isn't going to value in. I'm just saying.
Well, you've got a whole different world to deal with. You've got to deal with the valuation and making sure that you can get the finance against it. We've got to deal with, will this thing sitting on this land achieve the goal? Has it got a really high chance of getting growth above average, rent above average?
Yeah.
Give them some tax back or help them pay off their home loan.
In such a hot market, though, people are concerned.
They are.
They are panicked to buy and get a property, or they just think, oh, no, I'll wait. So
one of the biggest things, too, is understanding what's happening outside of your area. And a lot of our education, when we sit down with people, is talking about the regions that are growing faster than perhaps where they live. And sometimes they're areas where you may have a judgment. So in southeast Queensland, there are, between Brisbane and Gold Coast, there's a region of Logan. Out west of Brisbane, there's the region of Ipswich. It's the same in every capital city. There are regions where people make a judgment about who lives there, who's going to be their tenant. But there are areas in those cities, in those councils, that are absolutely booming, and they're putting in incredible infrastructure.
Look at Redbank.
Yeah, I mean...
What's happened at Redbank?
Yeah, Redbank used to have a stigma about it, and so did Forest Lake, and so did Coomba Bar on the Gold Coast. But those
Look at
areas are now
Springfield.
expensive.
Yeah.
Springfield, yeah. And so
Went from $250,000 to $1 million.
yeah, so we subscribe to some national research houses where they don't sell property, they just sell data. They don't sell anything. And we buy information off them about growth rates, population growth, property growth, as well as population growth, who lives there, what is their incomes, how many children do they have, also what infrastructure is being spent in those areas, because if billions of dollars are coming in, we know what that means from an economics point of view. If there's an abundance of supply, that means that there'll be slower growth. So we put all of that into the research. When we sit down on the second meeting with a client, if we're going to give advice, all of that comes into it. When we recommend specific types of properties, it's always based on what is driving that area. Because that can make you a lot more equity quickly than some other areas. And every area goes through spikes of growth. And so, like anyone that's listening that knows Southeast Queensland will know that one of our fastest growth areas has been the northern Gold Coast. So Coomera and Pimpama and these areas, whether you like them or not, they've just boomed. And one of the backbones of that was they created a massive Westfield. And so as soon as Westfield announced that they were going to build it way back 15 years ago, we started guiding clients to say, you should look at this. And some of them were like, why would we go anywhere there? It's the middle of nowhere.
That's where one of my clients made $1 million.
I know.
He bought a house for 400, just under 400,000. Sold it for 1.4.
We sold quite a few investment properties in there in the 300,000s, and now they're all over $1 million. And it's been a very strong. But those areas are everywhere because and they're announced way in advance. So Westfield, you know where they're coming. Bunnings, you know where they're coming. Hospitals, it's always predicted a year or 2 or 3 before they turn soil. And so for those who have a time frame, this is what has to be personalised. If they have a time frame that's long enough, 10 plus years, we love those areas because you will have a serious spike in growth, which gives the broker equity, right? And
the client gets the outcome that they want.
Correct.
So they want $1 million when they retire. Well, actually, just on that one property, it's like a lotto win. It's your lotto win for retirement. That's what I call it. And without people in places like Mercer and Cooper, it doesn't happen for some people.
Or they jump in and do it themselves. And I always think that's amazing. But it's better than doing nothing, usually. But you can do so much better. You can growth rates and
so I've had a lot of clients that couldn't get in the market years and years ago, so they bought 1-bedroom studio apartments. It's better than nothing, but their growth has been so slow. And you're right, in Melbourne there was all of those small little studio apartments and they were tiny and they just met your 42 metres squared rule.
Met it for lending purposes.
Exactly. I apologise for that.
That's all right.
I thought it was on airplane mode. But there's just so many of them, and it is that area that you've got to look at, what the property is, what your outcome needs to be.
Correct.
And you ask the questions. You might think you know how to do it, but talk to an expert to find out.
Especially an expert that's not going to cost you to go through a discussion and understand what you should be looking at. And so, a lot of people think, oh no, I don't want to pay anything, I'll do it myself. But there are companies like us, and especially us, that will sit down with you and create a strategy and a plan that you literally can go and do by yourself, but there's no harm in working with us because we want to create that strategy over time, and we want to...
So can you give us a story of a good story or a mishap story or a funny story or a story that the audience can relate to?
So, I've got funny stories that are more mishaps, that silly things I've done, like literally physical silly things like falling over and tripping in holes and things like that on sites, or hitting my head on door and bleeding in front of clients. But,
I've had didn't?
I have had that. Well, because I'm talking and looking at them and walking, and
bang. So
I've had a few instances where I've just hurt myself. And
so, mate, you really go. You'll put your body at harm's risk for the client.
More of a slight amount of stupidity, but it's funny at the time. But probably mishaps are more important for your listeners, and that is some of the things that we see people doing that actually can impact. And a lot of that, some of the most recent ones are people that make, you choose an investment property and they buy it the wrong way, they buy it in the wrong structure, and we see people. So we have a good conversation early days about structure. We have to in the very first appointment, because very few people understand. If you're buying in a personal name or a joint, two people, or 90-10%, 90%, 10% based on incomes and tax deductibility, or a family trust or a unit trust or a company. And so we have these discussions, and we've had quite a lot of clients who've signed contracts and done it in the wrong name, or in a name that they didn't discuss it with us. And then they come back and say they're unconditional, they're approved, and they want to change the contract. And we've got one right now that is going through a process where she's bought it in her own name and then wanted to put it in a family trust. And it's actually very messy and really can't be done. And sometimes they lose the property because the sellers are in control at the moment in this market.
In
this market, sellers can go no and then literally put 20 grand more on the price. And
well, they can have a backup.
Correct, and they do have backups, especially with new property. And we do a lot of new property because a lot of people are more interested in no maintenance, very rentable, maximum tax benefits, warranties, guarantees, in a region where there's strong underlying demand. And so, if they put it in the wrong structure, the developer just simply won't allow them. And so some of the mishaps are to do with things that can cost money and hurt people. And so we have that conversation early, and we have it with the broker too. We have it with you about making sure that they can do it that way, that we would highly recommend. Generally, we want them to get rid of all of their non-tax deductible debt first, and so we have conversations around. And for those who don't know what that means, basically it means your personal debt, your home loan, or any other debt that's in your name. We want that gone before you start paying off your investment property, generally. Because there's strong financial reasons to do that. And so, but a lot of the people we work with, they just want it to be principal and interest. And so if it's bought in the wrong structure and it's the wrong kind of loan, it can actually create a significant problem. And so we've had a lot of mishaps over the years where we've been trying to work very hard to undo what's been signed. If we weren't involved in the signature and the signing process.
Wow. So if anybody wanted to contact you, who would they contact?
So you can contact Mercer and Cooper. And so we're here at the northern end of the Gold Coast at Paradise Point.
But you deal with
nationally
all over Australia.
So we have properties and relationships every city, many regional cities. We are chasing capital growth and rental yield, rental return. Obviously, tax deductibility is important, but the number one, if I backtrack slightly, we're coming to the end, the only reason you would ever buy an investment property is to get richer. Right?
Yeah.
And the way you get richer is capital growth. But then we must get strong rent, otherwise the cash flow is difficult to handle. So people have to pay too much along the way with interest rates with the rent not covering all the costs. And then, so tax deductions help with that. They help with the cash flow. So rent and tax deductibility are all around cash flow, making sure that the journey is palatable and acceptable and it's not hurting you. But the number one reason way out in front is we want strong capital growth. So, and there are regions in every city, there are regions in every state, and certain regional towns and cities that are absolutely booming. And that's a conversation we have up front to do with risk.
I'm assuming you're not going to be selling them the properties that are in the middle of beside Urla Road and things
with a view of the rock.
With a view of the rock. Well, I don't know. No. There's no land there, but like in the middle of.
No, we stay right away from we stay right away from really regional, like single industry towns are just a no for us, like mining towns or towns that are purely driven off tourism or sugar or something. We just stay right away from it. It's got to have significant infrastructure, significant reason to live there. But there are regions in North Queensland and there are regions in New South Wales and Victoria that are very, very strong. And some of the data we subscribe to comes out with the fastest growing regional cities. Yeah. And some of the areas outside of Melbourne, some of the areas outside of Sydney and obviously all of North Queensland are very, very strong, even stronger than Southeast Queensland. But it is still a discussion around risk profile because some people simply can't imagine having a home that's 1,000 k's away as an investment property.
That's true.
And so
some people like to know that they can drive past it.
Correct. And so that's just a belief system we have. But
I had a real estate agent phone me up 6 months after a client bought an investment property and they said, "Can you talk to your clients?" And I'm like, "What about? They settled on the house 6 months ago." I said, "They keep driving past," and they knocked on the door and asked, to see if they could go around the investment property that they bought just to see how the tenants were looking after it when they had an agent in place.
That is, so we handle a lot of property.
You can't do that.
Well, you can't do that. And we handle property management. We have a whole property management arm for those who
So
want
sometimes
to.
that's easier.
Yes. So we have a team that look after the rentals if clients want us to, but there are a lot of rules and laws that are in favour of tenants.
And that's why you have somebody else.
Yeah. You've got to have someone manage it for you.
You need an arm's length with things. And some people are like, no, I'm going to hold it so tight. And then something happens. Like, they got fined.
Yeah.
And it was like, why
'cause
didn't you go...
Tenants have a rule around peace and enjoyment of the property that they're paying for. Yeah. So you can't do that.
And they're helping you pay down your home.
Correct.
And it's the same as if I talk about clients where if you put this into here and if you restructure it, you'll own your home.
Correct.
I had one client once, and this will be the last thing before I say your or you can say your website and how to contact you and make appointments. I had a client once that had 4 properties for investment. One was unoccupied. Unoccupied was at 80%. They owned 2 investment properties outright, and the other 2 were 60%. They had hundreds of thousands of dollars worth of tax debt, which they needed to refinance and structure. We refinanced, restructured. They owned their own occupied by the end of it.
Yep.
And they were like,
you.
why didn't... I have received about 36 referrals from this family. But it was like, because I went, who set this up?
Yeah, correct.
And then I said, I am not a financial planner. I can't provide financial advice. That's not my idea. But I can say, this is a structure that's going to work for you for your finance. And this. Let's talk to your client.
Yes.
Let's talk to your accountant. Let's talk to the financial planner. Let's talk to your real estate agent. Let's have a discussion. I don't care whether it's an open... I call it an open mic when there's 4 people in conversation. Let's go through this, and this is what we need. The client's like, oh, do you think we need... Yes, you do.
Sometimes that happens because they move. They live in a home and then they buy another one and move into it. And
they've lived
rent
in that house
one.
for 25 years.
Right.
So the person that was
that.
coming
That's
out
terrible.
to them, the first one set them up, interestingly. The second one set them up and pulled all the money out of their own occupied house to buy the others.
Yeah, just took
like,
the easy way.
Yeah, and one of them got sick. And then when they came back to it, they hadn't paid taxes and that because that's what that person had done in the businesses and used to sign off on and etc. But it was like, okay, let's get you sorted. And we did, and we got equal across, and we paid off the tax man, and he wasn't going to... But the taxation department can take your property, which is what people don't understand too.
Absolutely.
So you got to pay your taxes, guys. But so having something set up and being on that structure make a difference. Your owner occupied is what you live in. Nobody wants that to be hurt.
No.
That's what you've got your investment properties for. To sell, to make money, to take away, to have a life.
Yeah, to pay off your home loan if you still have a debt when you want to stop working.
Exactly.
And ultimately what we say to every client is that you will sell these, or you will sell some of these. They're not to pay off your home or to give you a lump sum into super or whatever is the best tax advice at that time, so that you can get on and live your retirement life or your, whether it's retirement age or even younger. We see a lot of people in their 20s and 30s, and of course they say, I want to stop working at 45 or 50 because that's a great goal. So, but it's still 20 years, and so we still got time. But whatever time it is that you say, I've had enough, I want to have choice now of what I do with my days. That's our goal, to create the wealth that's needed by that time frame. And so, but yeah, wrong structure, debt in the wrong place, it's extremely common. And that's a necessary thing before we even get involved, like making sure we get the debt in the right spot for the best way possible. Otherwise they have to sell things down. And
you don't want to be in that position.
No.
So if somebody wants to contact you, what's the easiest contact point? Would it be your website, Instagram, Facebook, LinkedIn? I'm assuming you're on everything.
We're on everything. Obviously our website is easy. Website is Mercer Cooper, so MERCER Cooper.com.au. And there's a number of avenues there where you can click and make an appointment. Or you can call us on our number, which is also on the website. And we're based, so we're based on the Gold Coast, the northern Gold Coast, but we have more clients around Australia than anywhere else and it's all done on Zoom and it's all done on Teams these days because COVID.
That's
did that
what
for us.
COVID
Yep,
did. COVID
did that.
changed
Made
our
us
lives
all-
with intercontinental
Yep.
and interstate.
Correct. So we have a lot of conversations with people in Sydney, Melbourne, Adelaide, anywhere, and many of them are open. They just want a result where the property sits. It may be where they live or in a region that's booming in their state, and we can advise on that. Or it may be up here in Queensland, or it could be another state altogether. We've had quite a few times where we're sitting in Queensland helping someone in Victoria buy a property in a different state, and and that's just the modern world. But it's based on their goals, their risk profile, their tolerance to risk, their capacity to borrow. And the areas of Queensland are really booming, so it's getting harder and harder to find properties at a certain price point up here. So we have to look nationally, but thankfully there are some really strong growth spaces all across the country. There are certain economic fundamentals that means some areas are likely for 10, 15 years to be ahead of the curve, but we have to fit in with capacity. We have to fit in with their capability, price-wise.
Because some people would come to you, because they come to me, and their capacity is $400,000 to take out.
Yep.
Okay, so they can't buy the $1 million property that they want.
Correct. This is just a side thing, because it happened this week. We often have conversations with a broker who's doing their best to make sure they get the best interest rate and no lender's mortgage insurance, right? So they come back to us with a capacity of $550,000, for example, which really limits anything that I would recommend in growth at this time.
Yeah.
So we have conversations behind the clients, sort of behind the scenes about the client, to do with the real cost of an insurance, deductible over 5 years.
Yeah.
And if they went to 85 or 87% instead of 80, it changes everything in terms of what they can do. And then we start to get into regions where the growth rates are hugely predicted for growth. And so we'd rather not, but we have conversations, because all that really matters is the result, right? It's not about minimising, or it's about, are we going to get the result?
Yeah.
So we have to work a lot with you and the people providing the capital and the lending. We would like to do that behind the client so that we can come up with a solution, and then we can sit down and have that conversation. But in terms of appointments on Zoom or Teams or physical face-to-face, and even in-home, we're quite happy to do all of those.
Okay. Thank you very much for your time and coming on to Money Mishaps.
No, it's been wonderful.
Money Mishaps. Money Chats and Mishaps. Gosh, I've even buggered that one up today. It's been a very big day.
It's been a pleasure. It's been a real pleasure.
So thank you very much for that.